Welcome back into Mining Stock Daily, everybody. We are going to jump into some market commentary specifically on the metals side of these markets and even dive into the junior mining market as well. We know there's been quite a bit of volatility. We're waiting patiently for some sort of bounce. We thought we may have had a tradable bounce late last week, but then geopolitics jumped back in once again over the weekend, and we all know how those stories come and go Monday through Thursday, and then reverse Friday through Sunday to once again coming back Monday through Thursday. And that's the way it's been for 3 months. So the precious metals market is trying to find some sort of floor. So I've brought back in Christopher Aaron from iGoldAdvisor, a man who lives and dies by price action, also does a pretty good job of packing a room at the Vancouver Resource Investment Conference for his presentation. So Christopher, good to see you, man.
Trevor, great to be back with you.
Yeah, it's been a while since you've been on the pod, but I remember the last time you were on, you were a little concerned that we had reached pretty close to that top. And dang, man, I mean, you didn't call a top, but you were pretty much spot on that things were getting a little fervorish. You were selling some. It was good job on that. You probably saved yourself from pain. But the rest of us are waiting here thinking, okay, when is this tradable bottom in precious metals coming? Are we starting to see signs? And so let's just pop right into that question. Are you seeing any sort of signs to where maybe this downturn in the precious metals has run its course?
Yeah, I am, Trevor. Let's talk big picture here on the precious metals themselves. Let's talk gold because, gold is typically in the leader role here. There's a unique twist going on with silver, which is that it just broke 6 months ago, broke above a 50-year high, the former 1980 high. Let's call it a 46-year high. Traditionally speaking, gold, though, is in the leadership role. So let's just talk about it for a minute. I mean, gold peaked at 5,600 in the spot market in late January. We're currently in the low 4,000s. I had been alerting my subscribers over the last 3 to 4 months, especially on that bounce that we saw back in March, where it got back up to about 4,900. I had been alerting my subscribers that the low was probably not in. We had a very distinct trend break in gold, about a year-long trend that was broken. It looked like it was retesting that trend from the opposite side. And I said, the message of a broken trend is that typically then after a retest, the market will roll over and make a new low. So I had been saying to my subscribers for months and months and months that on a vertical type move, on a sort of parabolic type move, which we had seen, late last year, you're not, when that breaks, you're not going to find support right away. It's not, it's not just going to be a one down and find support and come back up. And we can very clearly look back on the gold chart and see where the strong support is. FYI, guys, if you're you're listening to this audio only, you want to talk about what does strong support look like on a gold chart. It really looks more like when prices are moving sideways. When prices are moving sideways for a longer period of time, that's when there's equal buying and selling, and there's a lot of accumulation that had happened there. So all we have to do is really zoom this chart out. When is the last time that we had some good sideways type of price action? It was spring into summer of last year, 2025, when gold was in the 34 to 3,500 range. We had a nice 6-month consolidation there. So, that doesn't mean that gold has to fall back that low right now. But we take some of the trends that were developing back then in that consolidation, extrapolate those outward to today. Where am I looking at support? It's really like 3,800 to 3,900 for physical gold. I mean, late last week we dipped down to 3,960. So, I mean, we're basically already there. We're functionally close to that support now for gold. And then embedded into that discussion, I am also noticing a distinct bottoming pattern for gold itself, which is one of these falling wedge patterns. And a falling wedge pattern is a tricky one because it's a declining pattern, but it shows that the buyers and the sellers are mismatched from the standpoint that we expect the buyers to overwhelm the sellers within the coming, call it 4 to 6 weeks. So, you add it up. I'm seeing strong support 3,800 to 3,900. I'm seeing a bottoming pattern that looks like it wants to resolve in the next 4 to 6 weeks. What I'm expecting for physical gold here is a low, just below 4,000 over the next 4 to 6 weeks, and then a decent second half rally.
Hmm.
And by that, I mean, it looks to me like gold will make another attempt at the upper 4,000s or close to 5,000, third quarter, fourth quarter of this year. And after that, I will have to take a big step back and say, I need to see what the market needs to show me. Is this market ready to move again to new all-time highs, or does it need to form a much more complex kind of consolidation pattern in some of the recent ranges? But
Yeah.
decent move setting up, I think, second half of this year.
Yeah. Christopher, I mean, obviously, as I mentioned, you follow the price move and obviously watching these charts very closely. So let me come from my favorite area, and that's really the fundamentals of what the narrative is that would be driving gold to bottom to maybe have a nice run up to potentially 5,000 later this year, as you mentioned. And maybe my hypothesis is kind of similar. I'm seeing a lot of concerns in the equity markets on the back of this AI trade. We've talked about it quite a bit, but if there is weakness in the US equities and the hyperfinancialization of the US economic system, I am very convinced that a hawkish FOMC wash will quickly turn and do what needs to be done. And I'm just kind of curious if that playbook from that narrative fits in line with the chart pattern that you're watching and kind of expecting potentially to see 4 or 6 months from now. What do you think about that?
Yeah, this quote unquote hawkish new Fed regime, Trevor. I mean, this is this is the oldest trick in the book. This has been going back. This has been going on for the last 50 years.
Yeah.
Every new Fed governor to come in, suddenly it's a new page. It's we've reached a new reality in monetary. They've finally found religion, right? I mean, this is. Let's take a step back here. This is a banking cartel, to use the real term, that has been issued the control of the printing press in the United States. And yes, when things are fine with the banking system and the general economy, they will pay lip service to controlling inflation and controlling the monetary spigot. But it doesn't matter if we want to go back to the crash of 2008, some of the bond jitters under the Yellen administration, if we want to go back to Alan Greenspan post NASDAQ bubble, we all know how the playbook goes. When caught between a rock and a hard place, the Fed will always default to turning on the monetary spigot again, because their ultimate reason for existence is to ensure that the banking system is sound. When everything is fine with the banking system, fine, they'll address other parts of the economy. We just have to remember that in the background. Yes, so I agree. The markets are pricing in. Uh, right now, the markets are pricing in two distinct things, in my opinion. Number one, you just mentioned it. It's a new regime. It's less inflation. It's a Federal Reserve that finally cares about the value of the dollar. Number two, it's the end of the war. And even though we have seen a reignition of rockets being lobbed at one another here between Iran and the United States and Israel over just the last 3 or 4 days, and that's been going on here over the last half a dozen truces that have been agreed to. Uh, the market is in no uncertain terms already discounting the end of this war, even if this goes on for the rest of Trump's uh, term in office, where
Mhm.
every couple weeks there's a random attack here or a retaliation there. The market is saying that this is not going to morph into World War III. That's what the market is saying. I'm not saying that I necessarily agree with that. I think the history books remain to be written, but the market is saying there's no inflation to worry about because of the new Federal Reserve, and there's no inflation to worry about because the war is over. So you take both of those two things, and you have to remember that's what the market is pricing in right now. And so if one or both of those narratives change, I think, Trevor, that takes us to the rally that I'm expecting in the second half of this year. If the markets are fully pricing in those new realities, one or both of those switches, and I think we see a nice rally.
Yeah, absolutely. You did mention silver and kind of some wonky moves in the silver chart. So maybe let's revisit that, Christopher, and pop that open. Why is it acting so strangely here?
Yeah, well, we have to always remember the big picture perspective, especially at today's point in time with these markets. Remember, it was only last November. Here we are in June, end of June. It was 6 months ago that silver broke above a 45-year resistance level. That's the former $50 level from the 1980 peak and also matching the 2011 peak. And so we've seen, you know, I was cautious late last year when silver got back toward 50. It did sort of a little above 50, below 50, above it, below it for about 6 weeks, October, November. I thought it was going to top there for a third time and then have one more back off, and then have this move that we saw late last year. It surprised me to the upside. Markets are, always capable of surprising us. I never say I have a crystal ball, but what I do is I align with probabilities based on history, based on statistics. That's all we have to refer to in the markets. We always have to look at history for all forms of forecasting, whether it's meteorology, whether it's medical forecasting, whether it's financial forecasting. That's all we can do is look at history and project those models forward. Here we are. We had nearly a doubling above the 1980 high. Uh, and now we've come back toward the upper 50s as we are speaking today. Um, the most obvious point is that after a 45-year breakout, when a market comes back circa the breakout point, which in this case for silver is $50 per ounce, we expect a retest. A retest is exactly what it sounds like. It's where profit takers on the initial surge are all exiting this market here over the last 6 months.
Mhm.
And the price action is basically daring whichever group of buyers, traders, buyers, physical buyers, industrial buyers, whatever group of buyers showed up last November to cause that 45-year breakout. The market is saying to them, "Hey, do it again. Show me that this was not a one-trick pony. Show me that this was not an outlying event. Show me that you're for real." And we are at that show me moment right now for silver. Uh, we're at 58 and change. You've got to remember retests don't always get precisely down to the breakout point, that $50 level. In more
Mhm.
bullish markets, if a market is going to take a more bullish stance, a retest will happen here. A retest will happen in the mid to upper 50s. Market will bottom. Sometimes you have a bit of a double retest. That's actually the scenario that I'm looking at, sort of like a low right now here, late June, a bit of a rally back up toward 65 or so, something like a double bottom late July, early August, probably where we are now, mid 50s. And then I'm looking at a more sizable rally second half of the year based on how the charts are setting up now. So we have to remember markets don't always precisely come back to touch their breakout points. Now, the final caveat of that, however, is that in more bearish instances, and this is where I say I don't know which one it's going to be. I just know the message of a long-term breakout, which is that when you come back into that vicinity, which is where we are now, this is a market retesting that 45-year breakout. But as I was saying a moment ago, in more bearish instances, you can actually have a brief dip below the breakout point. So can you imagine we get into a holiday weekend, whether it's 4th of July or maybe Labor Day coming up in a couple months? Can you imagine you get a Thursday or a Friday close down to 47 and everyone panics? It's one of these gut-wrenching
Yeah.
long weekends where we have to go home and sort of sit with a 40 handle again, and then you open the markets Monday morning in Asia, Sunday night in the United States. You have the brief final capitulation, and by Tuesday morning it's back above 50 again. And then that marks the low. And it got all the investors, all the traders, I should say, because long-term investors are probably not selling here, but it got all the traders out of this market right at the low. Sometimes in more bearish instances that will happen. So as a trader or investor, you have to build both of those scenarios into your plan. You have to not go all in at any one moment. You have to build a bit of a buffer zone into your buy program over the next 4 to 6 weeks, getting into late summer.
Yeah. Sentiment in the metals obviously in the tank compared to where they were, back at the Vancouver Resource Investment Conference here, Christopher. Nobody wants the metals. There's no talk about it. Nobody's reporting on it, even though the trends are lower. But we'll see if we can establish some sort of floor here, as you eloquently laid out. But let's finish real quick with the equities, specifically the miners, the explorers. Obviously, nobody wants these either. They have been left for dead. And good thing a lot of these companies were able to finance last year when the market was hot, able to go out into the field, do good work. But even with $4,000 gold, Christopher, the miners are just raking in cash. Do we experience a time where maybe the margins, continued margins, even if gold hangs out at $4,000 and doesn't make a bounce, the margins are still improving? Do we finally see people waking up to this and saying, you know what? There's risk everywhere, but this is about as stable as it can get.
Yeah, Trevor, if we were to have rewound, let's call it 3 years ago. I mean, 3 years ago, for crying out loud, gold was trading at $1,700 per ounce.
Right.
Even here in the low 4,000s, gold has nearly tripled in 3 years. I know a lot of these companies that are still basing their PEAs or their pre-feasibility studies because they have to. They're basing it off the last studies that they've published. In some instances, they're studies that were from late 22 or 23. I'm seeing 1750, used as base case for some of these studies that are still out. I mean, these economics are going to be they're going to blow out of the water some of the previous estimates from
Right.
2 or 3 years ago. Uh, so when I look at the overall, I focus heavily on the small cap miners. That's where I feel I have an advantage because I can get to know managements. I can negotiate terms when I'm investing in these companies. Um, when we look at the index, the Canadian Venture Index, the CDNX, which is not a perfect proxy for gold and silver juniors, but it's the best that we have. It's about 2/3 mining companies in that CDNX index, and they're small cap Canadian mining companies, which is what I tend to focus on. When we look at that index, um, it is it is very close to breaking out from a 12-year consolidation pattern, a 12-year base. It has been moving sideways for 12 years, and I should say moving sideways at the lows for 12
Mm.
years. The index is currently at about 900. It's been oscillating between about 500 and 1,000 for the last 12 years. So a range along the lows. But for context, it peaked 2 decades ago above 3,000. So it's still about, one quarter of the value that it was back then. Um, Moving sideways for 12 years and bumping up along the base resistance. It looks to me like the entire CDNX, the entire Canadian Venture Index, the small cap miners, want to have a breakout later this year, perhaps into 2027, 2028. It looks like they want to have a legitimate breakout and a legitimate run. Now, long term on the metals, we talked about there being a decent rally second half of this year where I think gold could get back closer to 5,000. I think silver could get back to 75, 80 in that range, and we'll see where things stand then. If it happens to be that those rallies in the metals do not lead to new highs, in other words, this market needs to consolidate for a longer period of time, I still think the chart for the CDNX is setting up for a breakout. The chart for the development stage miners specifically is setting up for a breakout. And I simply think there's a matter of like we've talked about, we have these high margins here right now. And I simply think there's a delay factor. We've seen the cash, we've seen the printers on the large cap companies. We've seen the margins on the large cap miners. I simply think that, as long as the metals themselves don't crash, which I don't see, I see there being a decent rally second half of the year, and then we'll see after that. It looks like to me the development stage miners are going to have a good run second half of this year into 2027. And then we'll reevaluate. I'm not someone who has to say, we have to stay married to this asset class for the next decade. After a decent run on a breakout, I'm going to reevaluate. Maybe we can talk then again with the listeners, and we will see where we are. But that's what I'm planning for the second half of this year.
All right. Well, let's talk on the way up to that point before we get there, Christopher. So at least we can have some good news and a good conversation along the way. Great conversation. Always enjoy it. And obviously, you paint a pretty interesting prospectus of the next 4 to 6 months here. Let's talk again in 2 months and see where we're at. iGoldAdvisor.com is the website. You do offer subscription to the newsletter and lots of communications with your subscribers. Thank you so much, my friend. Good to see you.
Thank you, Trevor. And followers can also, for free, get daily updates at iGlobalGold on X or Twitter. Thank you.
Thank you.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.